Does a 1031 exchange have to be an investment property? Can you use a 1031 exchange to acquire a primary residence or vacation home? Well, the answer is it depends. And in this video, I will show you why. You've heard 1031 exchanges allow you to defer taxes, but what properties actually qualify for a 1031 exchange? In this video, I will show you the exact types of properties that do qualify and all the ins and outs of a 1031 exchange. If you're hoping to defer taxes using a 1031 exchange, watch this video. I'll show you exactly what properties qualify for the exchange, and not all properties are treated equally. There are types of properties that don't qualify for an exchange, and I'm going to break them down here. By the end of this video, you're going to know exactly how a 1031 exchange works, what the IRS considers investment use, and how to avoid disqualifying your 1031 exchange and making sure you fully qualify for one, helping compound your wealth. So to qualify for a 1031 exchange, the short answer is it must be an investment property or a property that is used for business purposes. A 1031 exchange only qualifies for properties that are for rental or investment purposes and or your own business purposes. Any other purpose does not qualify for an exchange. So to get to the heart of it, you cannot exchange your primary residence. You cannot exchange into a second home. If you are using these for personal use, they do not qualify for a 1031 exchange. The IRS rules are pretty clear that if you or an immediate family member lives in it, it does not qualify. So what types of assets do qualify for a 1031 exchange? Well, rental homes, short-term rental homes, commercial properties, apartments, industrial, warehouse, office, mobile home parks, self-storage, car washes, data centers. They all qualify for a 1031 exchange use. And a question I get a lot is, does land qualify? Yes, you can invest in land as long as it's for rental or development rental purposes. You cannot qualify for these types of properties. Single-family homes you live in, vacation homes that you or your immediate family live in, or land that you're going to build a primary residence or second home on. Also, fix and flips. If you bought and flipped the home within 6 months and you're going to flip the next home, that does not qualify for a 1031 exchange. If you are selling a primary residence, don't worry. You do not have to pay a portion of the tax. Section 121 allows you to not have to pay tax if you file jointly as a husband and wife, where the first $500,000 of profits or capital gains on your primary residence is tax-free in America as of 2025. And if you file as a single person, the first $250,000 of capital gains is tax-free on your primary residence. So here's a special case that people don't know about. If you do want to buy a vacation home, you can 1031 into it, but there's a couple nuances you have to know. First, you rent it out for at least 14 days out of the year. Next is you personally don't use it more than 14 days a year or less than 10% of the total rental days. So if you rent it for 200 days a year, you don't use it for more than 20 days out of those 200 days. Next is you hold it for investment purposes for at least 2 years. So you used it for personal use for a year, but then you held it for 2 years for investment purposes. At that point, you would be able to qualify for a 1031 exchange. This is the safe harbor rule set by the IRS Revenue Procedure 2008-16. So what does the IRS really care about here? They want to know, was the property truly held for business or rental property or investment purposes? That is it. Did the property generate rental revenue and did you advertise it for rent? Did you have it actively managed or did you actively manage it or was it used to help manage a part of your business? So that's it. It's very simple. You can find any property that you're going to use for rental, investment, or business purposes. So once you're ready to sell that investment property, then you're going to need to identify at least 3 properties within 45 days after the sale, and you must close 180 days after that sale to qualify for the 1031 exchange. Those are very important timelines. If you don't hit them, you will not qualify to defer taxes. So to wrap up, strategies that don't qualify for a 1031 exchange, but things you may want to know. Remember, if you're selling your primary residence, you have Section 121 where you do not need to pay up to $500,000 of capital gains tax if you're selling that residence and you've held it for at least 2 years. Or if you're single, $250,000 on the capital gains and you held it for 2 years. Another nuance is if a property is mixed use and you live in a half of it and the other half you rent out, you can portion off half of that property in 1031 exchange. that half of the proceeds. So if for some reason you are not going to 1031 exchange, but you want tax benefits, you can always execute on an installment sale. That means that you're not receiving all the cash at the time of the closing. You are carrying a mortgage for the buyer. They're giving you a down payment, and the balance of the payments will be paid to you over time, where you charge an interest rate anywhere between 5 and 15%. The buyer will pay that interest rate, and then if they do not pay, then you can foreclose on the property and take the property back. This is advantageous for a lot of sellers who have owned a property for a long period of time. They do not want to find another replacement property or investment property, but they still want a passive stream of income. Now, you do not have to pay capital gains tax on the portion of the installment sale that you put a note on, or the mortgage portion. You do have to pay capital gains on the down payment. If you are receiving principal payments on the loan that you're carrying, you will have some small capital gains tax that you will have to pay, but you will not be paying capital gains on the interest portion. You will be paying ordinary income tax on the interest income that you're generating from the loan you're carrying on the property. Another strategy is investing in an opportunity zone property, where if you sold a business or a piece of property, you have a large capital gain. You can invest that capital gain into the opportunity zone property, and then you will defer taxes. And if you hold that property for 10 years, then your tax could be wiped out on the portion of the capital gain that you reinvested into. Now, there are other nuances around opportunity zones, such as having to develop or improve the value of the property twice the amount of the value that you bought it, meaning that you'll have to develop on that property within a 1 to 2 year period of time. Opportunity zones are another strategy. I'll do a full video on it, leaving the link in the comments below, but it essentially allows you to take the capital gains of a business sale or a property sale and use those funds into an opportunity zone property, therefore deferring the tax. And if you hold that property for 10 years, you completely wipe out the tax. But there are nuances to it, so watch the video on opportunity zones below. There's also DSTs, which are Delaware Statutory Trusts. These are trusts, the only qualified trust in the United States that allow for a 1031 exchange to invest into this trust. And I have other videos about DSTs below in the comments. Please look at the link if you're interested in learning more about DSTs. And then lastly, tenant in common properties. This is another avenue to reinvest 1031 proceeds into a fractional owned interest of a real estate property, where each owner of the property has a ownership interest in the deed, and they're able to 1031 exchange into this vehicle. So now you know the nuances of a 1031 exchange and the fact that it has to be a business or investment use property in order for it to qualify as like-kind real estate. Check out the next videos that I talked about here. DSTs, tenant in common, other strategies that you can use to reinvest into property if you don't want to find an investment property yourself. So check out that video. Thanks for watching.